Good morning. Welcome to Stock Market Today for Thursday, May 28th, 2020. I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter. I'm at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where we get a lot of the content for this show, as well as give you daily stock ideas to consider. Those hit your inbox every trading day before the market opens. So U.S. equities finished higher in Wednesday's trading with strength into the close, pushed above the key 3,000 mark and the 200-day moving average. All sectors were higher, led by financials and industrials, as that cyclical rotation continues to play out. Tech and comm services were the biggest underperformers. Treasuries were flat on the day. The dollar was stronger against the yen, but weaker against the euro. Gold was up 30 basis points. WTI crude was down 4.5%. Crude has had a huge rally over the past few weeks. As we get to the desk this morning, futures are flat to down slightly after extending that rally on Wednesday. Asian markets were mixed overnight. Japan up 2%, but Hong Kong, Taiwan, and South Korea all finished lower on the day. European equities are mostly higher. Treasuries are unchanged to weaker at the back end of the curve. The dollar is unchanged against the yen and the euro. Gold is up 0.5%, and WTI crude is down 1.1%. So here it is, folks. There's the breakout we've all been waiting for, right? That key 3,000 mark, psychological, coinciding with the 200-day moving average, and we finally pushed through it. Now, so what happens? We've continued to say that a break of this level would target the next stop in our roadmap at about 31.10 for the index, and a break there targets the February highs. I honestly cannot believe I'm talking about targeting the February highs, but the market doesn't care what I believe. It doesn't care what you believe. It doesn't care what any of us believes. It is going to go where it is going to go, and that is why you don't fight the tape. Resistance having been set now, in the near term, should we break lower from here? Should this end up being a false breakout, which is always a possibility? You have to think about 2850 to 2900 to the downside. And that roughly is this gap, right? 2850 to 2900 is this big gap here. Below that, 2750 is the rising 50-day moving average. Now, we are overbought in the near term, looking at the 13-period CCI. And Chaikin money flow is flat, tilting bullish today, right? So we're kind of oscillating above and below the zero line. So breakout increases the odds that we go here, right? Which lines up with that interim rally after the sell-off started. That's kind of interesting. 3110 is also a 76.4% retracement of this move down. One of the lesser known retracement levels, but it is one that folks pay attention to. So I just wanted to highlight that. It's part of our roadmap as we kind of run through the if-then scenarios in the market, pretty much as we've been doing since the lows. Key levels get broken, we look to the next level of the upside without fighting the tape. We don't remain dogmatic in any of our views, and neither should you. Taking a look at our market in a minute now, what are we writing about today? Well, we rallied through key resistance, and it was led by small caps once again as this rotation plays out across cyclical sectors, across the growth value dynamic, across the big small dynamic. So with that in mind, today we are screening for bullish stocks in those cyclical sectors, and I'll walk through that while being mindful that it would be great to see a confirmation from the commodity market. It's kind of interesting to me that the commodity market is not ripping higher the same way that the equity market is. Breadth continues to improve as participation broadens, and futures point, as I said, to a flat to slightly lower open here today. Taking a look at the major indices now from a power bar perspective, the Dow up 2.2% yesterday, cyclical rotation, 4 to 7 bulls to bears. S&P 500 tax on 1.5%, 87 to 116 bulls to bears there, an improvement. The NASDAQ was an underperformer as some of the growth names are being sold. 31 to 15 bulls to bears, and small caps have been the big beneficiary here of late. 312 to 622 bulls to bears for the small caps. Bonds downtick, sending yields higher. Financials, again, a cyclical sector up 4.3% to lead the major sectors on the day. So again, as I said, I think I'm going to keep this a regular Thursday theme. where instead of having a stock of the day, I will have a screen that I think is interesting, that I think makes sense. Now, screens are for idea generation, right? You don't take a screen and run out and just blindly buy the stocks that are on it, right? It's an idea for, it's a tool for idea generation. We have it here at Chaikin Analytics. And what I wanted to do today was say, look, nobody knows if this rotation is going to have legs. We saw similar rotation in the fourth quarter 2019 that quickly gave way as the new year started. But if this rotation is gaining legs, I wanted to screen the cyclical sectors of the market, so materials, energy, financials, and industrials, for names that were bullish, very bullish, or neutral plus. Now, a neutral plus is a stock that is bullish fundamentals, but is trading below our long-term trend line. So the screen returned 33 names, right? Does this mean you go out and just buy them all? No. Do you just pick one and buy it? No, you do more work. I think it's an interesting opportunity to do more work in an area of the market that is seeing some near-term upside, right? And if there are compelling names there, it makes sense to maybe start to put some money to work if the setup is there for you, your style, and your time frame, as well, and manage risk. Because if this really is just something that's mean reverting, right, you'll quickly know, right, because you'll get stopped out of the trade. You manage your risk that way. But if it turns into a bigger trend, now you're involved. Now you have a list to work with. Now you can continue to add to it as you get confirmation that the trend is gaining traction. So interesting screen of cyclical names that are bullish, very bullish, or neutral plus here at Chaikin Analytics. Turning now to our sector tracker, the movement of the major sectors here over the last 5 days. And I have to tell you, it speaks to the same story that we've been telling for the past week and a half, 2 weeks, right? Financials, industrials, top of the list. REITs, getting a bit of a rebound. I think that's a little bit of a reopening trade as well. Same with discretionary. When we get to the leaders, you'll see what I mean there. Materials, utes, energy are middle of the road. Staples, comms, healthcare, and now tech at the bottom of the list. We don't like to see tech at the bottom of the list as an equity bull, just given its weight in the index. Same with healthcare. I mean, tech and healthcare are roughly 40% of the S&P 500, right? So that's kind of interesting. Rotation is important, but these are your leaders. They drive the bus. Okay. So the question is, right, these are the areas of the market that we've liked. And in the near term, they're underperforming, while the areas of the market that we haven't liked are moving higher. So again, there's that rotation. It can happen quick. And if we get confirmation that it is in fact gaining traction, our views will adjust. Looking at our industry in focus now, speaking of industrials, aerospace and defense, which has been a mess, quite frankly, over the past 6 months, lagging the S&P by close to 19%. Power bar ratio, very weak. 5 bearish stocks, 1 bullish stock, currently ranked number 19 of the 21 subsectors that we track. So some of the names there that we want to avoid: TransDigm, TGG, Aerojet, AGRD, and Cubic, CUB, all with very bearish Chaikin power gauge ratings. So as we look at the chart of XAR, we can see the bearish rating for the ETF, and the trend is still weak, right? Which is kind of interesting, right? We've had some nice near-term rallies here, but the trend does remain weak below the declining long-term trend line. Money flows turn bullish. The fund is overbought in the near term, and it continues to be an underperformer. Now, the intensity of underperformance has diminished of late. And you're seeing that across a lot of these cyclical sectors and cyclical groups within the market, but they still are underperforming. So you kind of have to know your time frame as well. So that's important. I'm not quite there yet on XAR, but obviously I'm paying attention. I don't remain dogmatic in my views ever. Trending names now, and here's what we were talking about as it related to discretionary, right? Gap up 18%. That's a reopening trade. GW Nordstrom, big move higher in front of their report tonight. Again, you know, as the economy is showing signs of reopening, as things are trying to get back to normal, these beaten down areas of the market are starting to pick back up. Kohl's, KSS up 14.5%. Discover Financial, nothing company specific to drive trading there. That's stuck up 12.5%. Norwegian Cruise Line up 9.73%, as that is another member of what I guess I would call a reopening basket. The loser side of the board are kind of a who's who of what was leadership to some degree. right? Fortinet, big name in the software space, was a big outperformer. So some of the rotation is taking money from those big outperformers, squaring up portfolios and putting some money to work in the areas of the market that have been beaten down. Fortinet down 4.6%. RMD kind of fits that bill as well. ResMed, one of the key leaders in the healthcare space, down 4%. MSCI, kind of one of those kind of financial market services stocks, if you will, like MSCI, S&P Global, were really big leaders coming out of the bottom. And now you're seeing some money rotate out, right? MSCI down 3.3% on the day. CME down 3.25%. Jack Henry, JKHY. I can't really fit that one into a theme, and that's fine, whatever. It was down 2.7% yesterday on the day with no company-specific news. Now, sentiment and positioning. Now let's talk about breadth, right? Market breadth, and I apologize, this should say market breadth. Real time, we're doing this in real time, folks. Breadth is improving, right? The percentage of stocks above their 200-day moving average has moved higher, now at 43%. Percentage of stocks above their 50-day moving average is above 90. I guess the case, that's obviously a sign of broadening participation. Even the advanced decline line has ticked back above this downtrend line that we drew last week. Still a divergence, right? We're kind of in line with these highs from late April. So still a small divergence there. There is a divergence if we look at the percentage of stocks above their 20-day moving average as well, right? Not confirming the recent highs in the market over the past couple of weeks, but divergences again need to be confirmed, right? You need to see a breakdown. Until then, they're a warning sign, right? Then you get the breakdown. Go back to January and February when we were talking about this divergence, right? As the market was making new highs, this indicator was making lower highs, right? And then when you broke through key levels on the S&P, right, you had a gap down on February 24th. You could say to yourself, okay, this divergence is now being confirmed. I need to get defensive. Similar dynamic at play here. In the interim, though, breadth is broadening out largely. You can make the case that it's a little overdone in the interim, in the intermediate term, but the simple fact of the matter is breadth is broadening. We're seeing broader participation. If that gains further traction, right? This is why we're talking about our roadmap. We have our roadmap to 3110, right? And if breadth continues to broaden as we get to 3110, you have to start thinking about the February highs. And that's just kind of how I go through it, right? No predictions, probability-based thinking by connecting data points. Small cap growth, right? So part of the rotation that we've seen has been small caps. And we've liked and written about small cap growth for a couple of weeks. We kept, when there were early indications of stabilization in small caps, we started saying the favor is towards growth, right? And we could see IWO, Russell 2 growth, right? Similar breakout as the S&P 500, RSI making a series of higher lows to kind of confirm that trend up in the market and in this group. But what's interesting to me is the trend against small cap value, right? So IWO versus IJS, small cap growth versus small cap value, is still very much intact here in the near term, but it's testing a key level. So while I continue to favor small cap growth, bullish rating, bullish power bar ratio, right? Nice trend from a price perspective. In the growth to value dynamic, it's at a key inflection point, right? So a lot of these subtle shifts taking place under the surface of the market, but I still think that in small caps, the place to be is growth over value, as long as this inflection point holds. And then finally, what I said earlier, commodities consolidating near the lows, not quite breaking out yet. And you just take a look at oil versus the S&P 500 as a key driver there, not breaking out as well. So that'll wrap us for today. Have a great Thursday, everyone.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.